So I think a lot of this talk this week was about the yield on the 10-year, higher for longer. The main thing, not so much higher, but longer. How high and for how long do you think are we looking at?
Well, the Fed put in one more possible hike in its projections for this year, and I think it did that really to give itself optionality in case the consumer is stronger than expected, wage inflation's higher than expected. But I think they also did that one extra possible hike to prevent financial conditions from working against them. If they had given the all clear signal, we probably would have had marginally higher stock markets, lower yields as people priced in the easing to come. And that would have worked directly against the Fed's goal. And then for next year, and I think that to your point, this is the bigger deal. Next year, the Fed went from projecting 100 basis points of cuts to 50. So definitely higher for longer than we had previously thought. And so part of what we saw in the market this week, particularly in the bond market, was an adjustment to this new Fed expectation.
Where are we in inflation? What kind of inflation pressure are we seeing right now? We obviously have gas prices really going up substantially, but inflation hasn't gone away.
No, not at all. It's interesting. The market took a lot of solace today in that core PCE figure, the Fed's preferred inflation measure, because it came down as expected, and the month-on-month number was just a little bit better than expected. But when you take a step back from that, right, the Fed is trying to get to 2. We're still well over 2. And to your point, you've got some risks out there. One from the service sector wages, which are still rising, depending on how you measure, around 5% annually. The Fed has suggested that needs to get down around 3 to be in line with their target. And then to your point, commodities, the Fed tries to look through commodities in the short term, but oil and food especially have an outsized impact on the economy through the consumer. We spend so much of our disposable income on those things. And if oil keeps going, we're at $95, $96 a barrel on Brent crude right now. We go to 100, hold around those levels for a while. It hurts disposable income. It raises inflation and inflation expectations. And that, again, is going to work against what the Fed's hoping to do with its soft landing.
So much of this has been tied up with the labor market, and we've heard repeatedly how tight the labor market is. Loosened up some, but it still is a fairly tight labor market. What do we need to see? What does the Fed need to see out of the labor market for us to have that proverbial soft landing?
Yeah, so the soft landing, the idea that we can get inflation back down closer to 2% without a recession, that was what the Fed projected last week. I think you need to see labor market normalization that comes mainly through a reduction of openings and an increase in participation with very few layoffs. Now, to the Fed's, it's not the Fed's credit, they didn't do this, but so far that is kind of what's happening. Participation has inched a little bit higher. Job openings had been 12 million. We're down to about 9. We get another report next week. It'll probably be around 8 or 9. But pre-pandemic, those openings were closer to 5 million. So we still have a long way to go. If that happens, think about it. If we just reduce openings, it reduces competition for workers, reduces wage inflation, but everyone who has a job and income keeps it. That's your soft landing scenario. But what's probably more reasonable is you get some of that and some job layoffs. And layoffs have been very, very modest so far. But we're seeing consumers get more cautious. We're seeing companies get more cautious in business sentiment surveys. If that translates into more layoffs going forward, then it's going to be harder for the Fed to get that soft landing. It'll be a greater risk that companies, consumers keep pulling back, and we have probably a modest recession at some point in the year ahead. That would probably be my base case, but I think it's going to be a close call.
One tiny clarification. We hope we'll get jobs numbers next Friday. If the government's out, we may not get those jobs numbers.
Yes, that is a fair point. If we do get the shutdown, which seems increasingly likely, the Fed's job gets even more challenging because some of the government figures that are put out by the Bureau of Labor Statistics aren't going to arrive. So then you have to rely more on private sector data. And data, when it does come out, will be very lagged. So it'll be interesting to see how the Fed wades through that morass.
Finally, talk to us about the dollar. The dollar's been quite strong, and it's been basically buoyed by some of these higher yields as a practical matter. Where are we going with the dollar, and is it good for our economy or bad for our economy? The dollar is so strong.
Well, the Fed's probably really happy to have a strong dollar right now because at the margin, a stronger dollar is going to reduce inflationary pressures. But the dollar, as you said, just in the last month, the dollar was up a couple of percent each against the euro, the Japanese yen, the British pound, and even more so against several emerging market currencies. What it does is It's going to be helping exports overseas. So Europe is a big exporting economy. A weaker euro helps them longer term, but it's working against the ECB's goal, the European Central Bank's goal, because a weaker euro is going to push up inflation there, and they have inflation too high as well. Net, I think it's a marginal plus for U.S. equity markets vis-a-vis overseas markets.
Rebecca, I don't want to look a gift horse in the mouth, but how much of the dollar's strength is because we're doing so well, as opposed to that they're doing, whoever the they is, are doing so badly, whether it's China or Europe, other places around the world?
I think the dollar strength right now is actually a reflection of caution and maybe even some anxiety on the part of American investors. It was really interesting data point this week. Japan releases who's buying and selling their stocks every week. And what we saw in the latest data is that foreigners, mainly Americans, were selling Japanese stocks last week right after that Fed meeting when they revised up their expectations for rates at the fastest clip since the March bank crisis. So it's Americans saying, okay, Japan's economy is doing pretty well, but I'm nervous about where the world's going, so I'd rather have my money here at home where I know my companies, I have my T-bills giving me 5%, and that lifts the dollar. So the dollar does tend to do well, interestingly, in economic downturns, even if it's a U.S. triggered downturn.